Welcome everybody to the Ellsworth Advisors monthly video. I'm Kelly Keenan, this is my partner Cameron Mealy, and today we're going to run you through what's happened in the past month from an economic standpoint and from a portfolio standpoint. Cam's going to start off with some economic numbers, and then we'll kind of go through some of the hot topics of what's been going on in the market and the economy. Cam, kick us off.
Thank you, Kelly. Last week, the Bureau of Economic Analysis published their advanced estimate for fourth quarter 2020 GDP. The advanced number is a 4% increase in GDP. So as you remember, we had a significant decline in the first quarter of 2020, a historic drop in the second quarter, historic rebound in the third quarter, and now a nice, healthy, continued growth in the fourth quarter. If 4% is the final GDP number for 2020, that'll show a year-over-year decline from 2019 of 2.5%.
Okay, minus 2.5, got it.
Yeah, which if you look at a decline of 2.5%, that's the largest decline in GDP since 1946, which is remarkable considering we've just suffered through the worst pandemic since the 1918, 1920 Spanish flu that infected more than 500 million people. So again, we've talked about this theme, but this really shows the resiliency of the U.S. economy, the balance of the U.S. economy, where you have a significant number of losers, but you also have a significant number of winners. It also shows what a heavy dose of government spending can do. So it looks like GDP for 2020 will be down 2.5%. 2021, the consensus, according to the Wall Street Journal of leading economists, is an increase in GDP of 4.3%, which is very strong by historical standards. Much of the increase will be driven by the services sector, and a recovery in whole is predicated on continued vaccine rollout and more government spending. So I have to get this vaccine rollout going. It certainly looks like the Democrats are going to push through a huge spending bill that'll help support the economy. That takes us to 2022 GDP. And again, the Wall Street Journal's consensus estimate is 3.2% growth, which again is extremely healthy. So it looks like we're going to have, according to leading economists, 24 months of strong economic growth. The Bureau of Labor Statistics, when we look at unemployment, the final estimate for 2020, before the final number, the final estimate, is 6.7% unemployment at the end of 2020. Still very healthy by historical standards. Again, Bureau of Labor Statistics is expecting that by the end of 2021, unemployment will be at 4.8%. By the end of 2022, it'll be at 4.3%. So strong economy produces continued opportunities for employment. And then we talk about inflation. The inflation expectations for the next 24 months is approximately 2%, which again it's not runaway inflation. It's not, kind of these zero interest rates that we're seeing. It's a healthy amount of inflation. So I guess it begs the question, if we have healthy GDP growth, we have healthy employment, we have inflation in line with normal norms that we've seen, what really could drive a recession? We're probably talking about headline risk, political risk, new coronavirus strain, vaccine, failing to roll out in a timely manner, political crisis. I mean, fundamentally, everything looks very strong.
Yeah, I think fundamentally we're definitely in recovery mode from what we saw last year. The risks that are out there, the inflation number, the Fed, basically, it used to be a hard target. We can't go over 2%. Right. Now they want to average 2%. So the reality is they very well may let inflation run hot. And the consensus, there really is no consensus on inflation. There's definitely two camps out there. One that with all the stimulus out there, constraints on supply, as the economy opens, that will show heightened inflation. Where I've seen numbers, 3-4%, even at 3%, okay, if you average that, the Fed will probably let it get at least that high. So there's strong arguments for inflation, but there's also still some strong arguments out there for disinflation, where actually you do not get inflation, and if anything, you may get prices contracting. What we saw coming out of the financial crisis, 2008-09, with all the money printing the government was doing, all the money they injected in the banking system, once again, these same arguments were out there. Actually, there were fewer disinflationary arguments, and the reality is if anything, we saw more deflationary pressures coming out of that than inflationary pressures. And for CPI, which one measure of inflation, the measure that the government uses, for the last 10 years, we really haven't seen a lot of inflation. But the reality is we definitely did not see wage inflation until the last couple of years, or maybe the last 4 years, where wages have finally started to pick up. If that trend continues, I think the arguments for inflation become much greater. So, but I don't think inflation pushes us into a next recession. I don't see us going into an official recession, 2 negative quarters, in the next 12, 24 months. There's just too much wind at our back to kind of push us through.
Much. I mean,
right.
We're talking right now about another $1.9 trillion of government spending.
Right.
You know, I think the PPP loans, our government fumbles around a lot, but I think the PPP loans were a godsend. I think the stimulus has been what we needed. And certainly, it's hard to find yield. So, why would money come out of the stock market? Why would there be more sellers than there would be buyers? I mean,
right.
If anything, we should continue to see money going into the market, and that's going to support, the market.
I think it'll support the fundamental side of the market. Mm-hmm. Because of all the stimulus, we have seen valuations get a lot higher than what they have been in the past. There's a portion of the stock market that valuations are definitely approaching, and there's, several factors that are lining up to what we saw in 2000 when we had the dot-com bust, but not all those factors are really there yet. So, how long can this go on? It can have some legs where, the fundamentals will continue to, fundamentally push the market up. What we've seen more recently is, and really call it since early last year, there's a lot of speculation now going on in the market. So, when we talk about the stock market, our approach is always buy individual stocks. So we're buying stocks, not necessarily the market itself. Mm-hmm. The headlines will always focus on the market itself and not necessarily individual underlying companies. And there's 2 ways to put money in the stock market. One is from a more speculative standpoint. Hey, I'm going to buy this stock because I think the stock price is going to go up based on news I'm hearing, or hey, a bunch of people want to squeeze the shorts on the hedge funds that are shorting GameStop. So if we keep on buying, this is going to crush them. That's speculative, just looking for that short-term gain in price, not necessarily based on what's really going on with the underlying company. Then you have the investing side of it where, hey, I'm buying these companies because they're good, solid businesses. They can grow their revenues. They can grow their profits. So you have that investment side, which usually, that's the biggest base to the market. Sure. That's what dominates. That's always there. The speculative side comes and goes. We could argue, but that speculative side, we really haven't seen this type of speculation since the late 90s. Even going into 08, 09, the speculative side of it really never showed itself to any major extent. That speculative side is ramping up. So it's kind of like, you have your base, but then you have all this froth and crazy stuff going on above it in that speculative side. And that speculative side, we're seeing that, and I think that's going to get even more heightened as we move into the next, several months and several quarters. I don't think that's going to calm down anytime soon. So that speculative side, that now causes, so we have all this froth going on. That will cause more, sharper dips in the market, quicker dips, quicker recoveries. We went into January, market was chugging along. We got into the last week or so of January, then the volatility kind of hit. So we had a 5% pullback in a matter of a couple days. Now after a couple strong days, that's kind of wiped out again. So these sharp corrections, I think, are going to be with us. Will they get deeper than 5%? I think we have to plan on it. Down to 10%, yes. I just think, at least in this environment, we see a 10% pullback. Probably going to turn around pretty quick, just because there's still
much capital.
There's a lot of capital on the sidelines. The whole market gets pushed down, and even the stocks we're holding. If I have cash on the sidelines, and those stocks get beat down 5, 6, 7, 8%. I'm going to go in there and I'm going to buy them, which I'm not the only person doing that. They're going to get bid up, and that kind of, there's our correction, down and then back up. So I think this year is going to be categorized by a lot of quick swings back and forth. We'll see some 10% corrections this year, just like we did in the fall. But, overall,
we think those are buying opportunities.
Yeah, they're going to be short term. They're going to be buying opportunities, and it's the bigger market functions that that could be a bigger washout at some point further down the road. Now, my tune could change 2 months from now, a month from now. It's just, how do these dynamics play out?
But what is interesting about this current kind of wave of aggressive valuations of the tech stock, it is very different, I think, than in 1999, because in 1999 and 2000, it was .coms. You throw .com after anything and it got a huge valuation. Do I think Amazon, Google, Facebook, Tesla, are they ahead of themselves? Yes, but fundamentally, those are great companies.
Oh.
And they've got a purpose for being around, whereas a lot of these .coms, they were just flash in the pan.
Right. Oh, I agree. The fundamentals are good, solid fundamental companies. They have good cash flows, good revenues. What we're seeing, we are seeing that speculative piece in the SPAC market, where before companies are coming public, or that whole SPAC dynamic, things are getting bid up right out of the gate. So even with IPOs, I think that still continues. A big difference between now and the day traders of the late 90s is the ease of doing it. And I remember this back in the late 90s when some brokerage firm, Schwab, led the way. They reduced commissions down to $8 a trade or $7 a trade, which back then that was unheard of.
Yeah, that was cheap.
And also back then, you couldn't buy partial shares like you can now. So now you can go, Amazon trades at $1,200 a share, all right, $1,300 a share. So if you want, back then you had to put $1,300 if you wanted to buy one share of Amazon. Today, because of the ability to buy partial shares with no commission, if I had $10, I could go open a Robinhood account and buy $10 worth of Amazon, a partial share. You couldn't do that back then. So basically, if you want to be a day trader, you had to have a couple $1,000 at least, if not more, to start day trading. Now, if you have $10, you can open a Robinhood account. They give you a free share of whatever, and right away, okay, start trading. You can trade a lot smaller dollar amounts. So I think part of what we've seen recently in the GameStop short squeeze and some of these other stocks, that is, they're small companies. They don't have a lot of shares. It's a small float, or what we call, and it's heavily shorted, meaning people have basically don't own the shares. They sold shares. They borrowed shares to sell in anticipation of the price going down. So all those shares that are out there are actually, 100% of the float is held short. Mm-hmm. It's a small stock, or small company stock, not a lot of buyers out there. The shorts just waiting for the price to go down before they repurchase to cover their shorts. But if you have a lot of buyers come in,
which I think there were 4 million
actual buyers
of GameStop, which
right.
is,
so 4 million, $10 a piece, that's, or $1,000 a piece, that's a lot of capital pushing up a very small stock, and that causes the dislocations in GameStop. But the guys that are short now, every time the stock goes up, they start losing money. They can lose more than they invested in that short position. So they have to cover their shorts or sell their, get out of their position. But to get out of their position, they have to raise extra capital because they owe more than what they got when they sold the stock. So what happened was, okay, what are we going to sell to raise capital? Okay, hey, I have a big gainer over here in Apple or Microsoft. So they're shaving gains over here, which pushed down the market in general. But once again, it was a short-term phenomenon because, hey, okay, these prices they sold off, somebody who maybe wasn't in there or wanted to add to their position, a little lower price, they bid them back up. We get a rebound yesterday and today in the market. Yeah. So that's kind of the dynamic that's playing out. But
expect volatility, but we're going to continue to focus on the fundamentals.
Exactly. And kind of, for the most part, I've been staying away from those areas. I mean, we held GameStop 10 years ago. Mm-hmm. We made, probably 35% in GameStop, made it, sold it. That business has changed. Nobody's in there. If I had a client that was holding that position, I remember going in last Thursday, I'm like, okay, if we have anybody that's still in there, we're selling it because we just made a 300% gain. That's not what stock we want to hold on forever.
Right.
Now, something that's changed is, so these day traders are looking for, okay, what stocks have big short interest? We can do it again, and we can, make another ton of money doing this. But the reality is so they tried to attack silver, which is a lot different market. Now you actually have real investors in silver. Mm-hmm. Silver has different dynamics than a GameStop, a kind of a company that's, let's call it maturing in a dying industry, or at least from the retail standpoint. They tried to do a silver. Silver had a nice little run up, maybe got up 10% or so. But
But silver has fundamental value.
But they weren't able to do it because you would need a lot more capital backing it. So you're going to see these attempts at these companies. Like I said, for the most part, we're staying away from the fray. If we happen to be holding something, they attack, or they go after it, it gets run up. The reality is realistically, if it's something where, hey, the fundamentals aren't driving this and it is driven by day trading, we're going to take our gains.
Absolutely.
When we can. And hey, if it pulls back down, we liked it fundamentally, we'll buy back in at a lower price. Yeah. So that's kind of how we're attacking it. It's going to cause headline news, but in the grand scheme of things, it's all about being able to get through the downturn, not needing the cash, staying away from where the craziness is, and continue on what we're doing. From a portfolio standpoint, last month, growth with income portfolio down 0.94%. To put it in context with the markets. So by the end of the month, like I said, things ran up. We had that 5% pullback. Dow Jones ended the month down 2.04%. S&P 500 was down 1.11%. NASDAQ was actually up a little bit, 1.42%. The Russell 2000, which measures small caps continue to chug along. They took a little bit of a hit last week, but they've rebounded well. Russell was up 5%. So our portfolio's growth with income, like I said, down 0.94. So really didn't feel the full downside of the market. Our big winners of the month, CVS up 5.6%. Lennar, the home building company, up 9.4%. J&J up 3.65%. Big losers last month, Visa was down 11.65%. Starbucks took it on the chin, down 9.5%, and Honeywell down 8.1%. Obviously Visa, Starbucks, and Honeywell, long term, we made a lot of money in there, so nothing I'm concerned about. On the dividend yield portfolio, for the month, kind of a disappointing month here, down 2.56%. Big winners of the month in there. Intel up 11.42. Intel definitely struggled last year. Nice bounce back there. So that's good for us. Blackstone up 3.67%. AT&T, another laggard last year, up 1.33%. Losers last month. UPS down 12.2. I think that was a winner the previous month.
Yes, it was.
LyondellBasell, which struggled early in the year, had a nice rebound, down 6.44 this month, and Waste Management down 5.6%. On the price potential, more of our growth portfolio, kind of between the Dow and the S&P, down 1.97%. Big winners, Biogen up 15.4, Amgen up 5%, and then Perkins-Elmer up 2.54%. Amgen, Perkins-Elmer, they're both in the healthcare arena. Perkins is really in the diagnostics analytics. So obviously with all the testing going on, that's, they're getting good business. We've been in there probably about 6 months, so we've made some money there. Losers, Edwards Life Science down 9.48%. Lockheed Martin down 9.3%. PepsiCo down 7.9%. Genpact down 7.45%. And actually all four of those stocks, same thing, like in the growth with income, those were winners for us last year. We made money in all those, just a little bit of pullbacks there. Our small cap portfolio, up 8% for the month, so great month there. This is where the crazy stocks come in. Fulgent Technologies up 112 for the month. Overstock.com up 62%. Proto Labs up 38%, Appian Corp up 34%. Fulgent and Proto Labs, Appian, those have already been big winners for us. They're just kind of adding to those gains. On the downside, iRhythm Technology down 29%, Kodiak Science down 14%, Green Brick down 13%. That's why the portfolio is up 8%. When you typically if we have some big winners like that, we have some even deeper losers. But the small caps are rolling right now, and probably a little bit of legs there. So that's really where we're at for the month. Like I said, we're kind of staying away from the craziness of the speculation side of it. Definitely an eye to inflation. We have some hedges put in there, but the key is we're going to focus on the fundamentals. The whole objective is, long term, if we end up going through a major dislocation, we want to be in solid businesses, not things that are actually, not the GameStops of the world where that underlying business, even if they gave it to me, I'd be looking for ways to get out of it because it's a dying business. They need some major changes there. So that's where we're at today.
If you have any questions, please feel free to give us a call. Thank you as always for your trust, and look forward to seeing you.
Have a great month and happy Groundhog's Day.